Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Asana, ticker ASAN.
Yes, and this is a fascinating one.
It really is. We're looking at a company that has gone through just a radical, and I have to say, very rapid transformation.
Mm,
They're trying to pivot their entire identity, from being a pure growth darling to becoming a champion of efficient growth and AI-driven scale.
all while staring down some pretty intense competitive and macro pressures.
Exactly. It's a huge high-stakes bet, and it really demands we take a closer look at the foundation they're trying to build.
That's the perfect framing for it.
Mhm.
The tension for Asana right now is, well, it's palpable. Their whole valuation hangs on pulling off a successful near-term inflection point.
So what's the core conflict here? Lay out the thesis for us.
Okay, here it is. Asana is betting its work graph differentiator and its AI consumption pivot, now led by new CEO Dan Rogers, will drive a reacceleration.
To justify the valuation.
Exactly. To justify its valuation against, on the other hand, persistent revenue deceleration and the acute competitive risk posed by rivals like Monday.com.
Whose retention is way higher.
Way higher. MNDY's net revenue retention is a staggering 16 points higher.
16 points. Okay, let's unpack this high wire act then. We should probably start with the foundation they've managed to build beneath them.
Good place to start.
For years, the story around Asana, like so many of these high-flying SaaS stocks, was just growth at all costs.
Right. Burn cash, get users.
So the first big shift we need to talk about is this dramatic, and I'd say successful, pivot they made towards sustainable profitability.
They executed this financial pivot with remarkable speed. It really silenced the critics who doubted they could ever find operating leverage.
What was the big moment?
The major milestone came in Q1 of fiscal year 26. That's when Asana hit non-GAAP profitability for the very first time.
And that's essential because it proved the model wasn't, inherently broken. It just needed some discipline.
It just needed discipline management, exactly.
And the efficiency gains didn't just stop there, did they? They actually accelerated into the second quarter.
They did. We saw the company report a 7% non-GAAP operating margin in Q2.
Which is an almost absurd 1,600 basis point improvement year over year.
It's a massive number. That kind of rapid scale back on OPEX is phenomenal.
So what gives them the power to do that? What's the structural detail that lets them make those cuts without just gutting the product?
You hit on the most critical underlying strength. It's their 90% non-GAAP gross margin.
The gold standard.
It is the gold standard in the SaaS world. It just means the cost of actually delivering the software is incredibly low.
So every new dollar of revenue is almost pure profit potential.
Almost entirely. It flows right down the income statement, offering immense leverage. And that consistency, combined with the spending cuts, it showcases some deep structural strength.
And that strength, that new financial discipline, it seems to have given their biggest customers a lot of confidence.
Certain looks that way.
Because what's fascinating here is that this new efficiency allowed Asana to lock in the largest deal in its history.
A massive one. A 3-year, $100 million+ contract renewal.
That is a huge vote of confidence.
It is. And that deal isn't just for a press release. It fundamentally changes the risk profile of the company. It adds so much to the remaining performance obligations.
Which de-risks future revenue.
It totally de-risks the revenue line and gives them much better visibility for fiscal 27 and 28. It buys them the time they desperately need to execute the next part of this pivot.
Okay, so profitability is now the baseline. But profitability alone doesn't justify the valuation, not for a company that's supposed to be growing.
Not at all.
Which brings us to their massive core technological bet, AI. They're trying to frame their future as the platform for human plus AI collaboration.
We've heard that from everyone, though, right?
We have. So what makes their approach any different? How is this not just slapping a Gen AI wrapper on a feature list?
It all comes down to their proprietary architecture. If you're going to bet on Asana, you are betting on the long-term competitive moat of their proprietary work graph data model.
The work graph. Management calls it the essential foundation.
They do. And you can think of it like a digital nervous system for an organization's goals and projects. It structures all the context, not just the tasks, but the who, what, when, and crucially, the why.
So a competitor's AI just sees a task, write a report.
Right, simple to-do item.
But Asana's Work Graph AI sees write a report that's dependent on marketing's launch, assigned to Sarah, and directly impacts our Q4 revenue KPI. Is that the idea?
That is precisely the differentiator.
Yeah.
That deep structured context is what they say will prevent these new AI tools from becoming shelfware.
Shelfware, meaning a tool that's cool but not actually useful in a real workflow.
Exactly. It lacks the context to be truly helpful. Asana is focused on enabling what they call the agentic enterprise, where the AI can actually take intelligent action because it understands the entire process.
And that distinction seems to be turning into actual money. Let's talk about AI Studio.
Right, the monetization is starting to happen.
We saw AI Studio ARR more than double in just the second quarter. That's on top of it already passing $1 million in ARR in Q1. People are paying for this.
Yeah, and this isn't just about selling a few add-on credits. The long-term ambition here it's massive. They're openly saying the goal is for this platform and consumption revenue to eventually eclipse our current subscription base.
Wow. So they want to move completely beyond per-seat licensing.
That's the vision. It's a fundamental change to the entire business model.
That is an incredibly ambitious goal. So what kind of execution risk comes with a pivot that dramatic?
The risk is enormous, which is why strong operational leadership is just paramount. And to pull this off, they needed a change at the top.
Which brings us to the new CEO, Dan Rogers.
A major move.
He's got a proven track record, right? Leading growth and go-to-market at ServiceNow.
A very impressive track record. His arrival signals enterprise rigor and a focus on scale. It immediately mitigates founder risk, and it tells investors the focus now is squarely on accelerating go-to-market.
Getting the product into more hands.
Exactly. The challenge isn't just inventing cool AI, it's getting their existing customers to use more of the platform to prevent churn.
And they're not just waiting for the AI model to mature to fix that, are they? They've rolled out initiatives to fix customer health right now.
That's right, like the Foundational Service Plans, or FSPs.
What are those exactly?
FSPs are basically mandatory onboarding and utilization packages. They're designed to make sure customers are actually using the seats they pay for.
Which fights the downgrade problem head on.
Correctly. And it's working. These FSPs have apparently driven a 20% increase in seat utilization in the accounts where they're deployed.
A 20% jump in utilization is a direct lever against that low net revenue retention number we're about to get to.
It absolutely is. It immediately increases stickiness. And looking ahead, the next big product catalyst is coming soon.
AI Teammates.
AI Teammates, scheduled for the second half of this fiscal year. These are supposed to be agentic collaborators that automate complex, multi-step workflows.
Okay, so we've covered the efficiency, the AI bet, the new leadership. Now we have to turn to the risks.
Right, because despite all of this, the core challenge is the persistent weakness in the legacy business.
So the core business just keeps slowing down. Revenue deceleration dropped to a frankly troubling 10% in Q2.
Which is a world away from the 44% growth they had just 2 years ago.
It's like they're building this new engine on top of a foundation that's actively shrinking.
That's a great way to put it. And you see that most clearly in the retention metrics. The dollar-based net revenue retention, the NRR, it remains a primary weakness.
Where did it land in Q2?
It recovered only slightly to 96%. Anything under 100% is a siren call for a business in distress. It means customers are downgrading or leaving faster than they're expanding.
Yeah, that 96% NRR, that signals real pain. Is it just the economy or is it competition?
It's a mix, but the pricing pressure is undeniable. Remember that huge $100 million renewal we were just celebrating?
Yeah.
Even that wasn't a clean win on price. The company confirmed the renewal, included a modest ACV downgrade.
Wait, a downgrade on their biggest deal ever?
On an annual contract value basis, yes. They secured the customer long-term, but had to give a little on the annual price to do it.
That confirms pricing pressure risk exists even in their largest, most strategic accounts.
And that's going to weigh heavily on the NRR numbers in the second half of the year.
What about getting new customers in the door?
Well, on the acquisition side, especially in the small business segment, they're facing what they call top-of-funnel headwinds.
It's from AI search disruption.
Primarily, yes. As search engines give you AI answers directly, that high-quality organic traffic that used to feed their SMB funnel is starting to dry up.
Okay, so we've got a company with fantastic margins, a credible, innovative AI story.
Weighed down by a slowing, price-pressured legacy business that's actually shrinking its revenue base from existing customers.
So does the potential, that 90% gross margin and the really compelling long-term optionality from the work graph, does that actually justify the valuation today?
That is the essential trade-off, isn't it? It's speculation versus reality. And when you look at the competition, the reality becomes crystal clear.
You have to look at Monday.com.
You have to. You contrast Asana's struggling 96% NRR and 10% growth with Monday.com, which is growing at 30% and has a much healthier 112% NRR.
That 16-point gap is just, it's a gaping hole in their story. It suggests Monday.com customers are happily spending more while Asana's are pulling back.
Exactly. And beyond the metrics, analysts have also raised some architectural concerns.
That Asana is too rigid.
Too rigid, less modular. Its biggest strength, that structured work graph, can also be a weakness in a market that prizes flexibility, which is where competitors like Monday.com really shine.
So where does this leave you, the listener? It sounds like a complex story. The reward could be massive, but the timeline seems very long.
I think ultimately the stock is a high-risk bet on a major inflection point. While the work graph and the AI pivot offer fantastic long-term optionality, any material revenue from AI that would really move that overall growth needle.
Moving that 10% back up to 20 or 30.
That seems unlikely until fiscal year 27. This requires a lot of patience and very keen monitoring of their execution. The profitability gives them the runway, but now they have to deliver.
So the key metric for you to monitor should be that dollar-based net revenue retention figure. If NRR stabilizes or starts to climb back toward 100% in the back half of this year, that's a great sign. It would indicate the AI Studio and those FSPs are working.
But if it drops further into the low 90s, the structural headwinds may be winning out.
That's the tell.
Risk defined. Portfolio protected.